Welcome to Factful Finance, where we break down the world of finance with clarity and precision. Today, we're diving into a question that's on the minds of many investors. Should I invest in real estate or the stock market? It's a critical decision that could shape your financial future. But here's a surprising fact. Over 90% of the world's millionaires have built their wealth through real estate. Still, stocks are the go-to for many seasoned investors due to their liquidity and growth potential. So, which one is right for you? Let's find out. Before we get into it, just a quick note. This content is for educational purposes only. Please consult a professional for tailored advice that suits your unique financial situation. Now let's break it down. Tangible assets with long-term gains. Real estate investing often feels like a safe bet. It's a tangible asset you can see, touch, and rent out for passive income. Historically, real estate has appreciated over time, offering investors stability and consistent returns. The average annual return on real estate has been around 8 to 12% in the last few decades, though this can vary depending on the market and location. But here's the catch. It requires significant upfront capital, and the process of buying, managing, and selling properties can be time-consuming and complex. Let's look at an example. Meet Alex, who saved $50,000 over 5 years. He used it as a down payment on a rental property. Fast forward to today. After renting it out for 5 years, he's been able to build equity and collect rental income, which is now his primary cash flow source. While his property's value increased by 5% annually, he still faced challenges, like property taxes and maintenance costs. Stocks, flexibility, and growth potential. On the flip side, investing in the stock market offers flexibility and a lower barrier to entry. You can start with as little as a few $100s and access a wide array of investments: stocks, bonds, ETFs, and mutual funds. The stock market has historically provided average returns of around 7 to 10% annually, but it comes with volatility. Your portfolio can fluctuate dramatically in the short term, which can be unnerving for some investors. Let's consider Emma. She decided to invest in a broad market ETF with a $10,000 investment. Over a span of 10 years, her portfolio grew by 8% annually. The beauty of stocks is that they can be highly liquid. If Emma needed to sell her holdings, she could do so in a matter of minutes, without worrying about finding a buyer for a physical asset like a house. However, Emma wasn't immune to market dips, and there were periods where her portfolio took a hit. But in the long run, her diversified portfolio allowed her to recover and continue growing her wealth. Key factors to consider. So which is better for you? That depends on several key factors. 1. Capital. Real estate typically requires more upfront investment. If you have access to significant capital or can qualify for a mortgage, real estate could be a good option. Stocks, on the other hand, allow for entry at any budget level. 2. Risk tolerance. Real estate is often considered more stable, but it's not without risk. If the housing market crashes or your property becomes vacant, you're exposed to financial stress. Stocks are more volatile, but their potential for high growth and diversification allows you to spread risk across different industries. 3. Time commitment. Real estate requires active management unless you hire a property manager, which can cut into your profits. Stocks, especially ETFs or index funds, are much more hands-off and require less day-to-day attention. 4. Liquidity. The stock market is far more liquid, meaning you can buy or sell your investments quickly. Real estate, on the other hand, can take months to sell and transaction costs are much higher. Real-world application. Let's apply this in another way. Imagine two friends, Brian and Sarah. Brian invested $100,000 into real estate 5 years ago, purchasing a rental property in a growing neighborhood. He's seen a steady rise in rental income and a 15% increase in property value. However, maintenance issues, property taxes, and occasional vacancies have given him some headaches. Sarah, on the other hand, invested her $100,000 in a diversified portfolio of stocks. Over the same period, her portfolio grew by 9% annually. The fluctuations in the market were unsettling at times, but she stayed the course and even took advantage of market dips to buy more shares. Making your decision. Ultimately, it comes down to your personal goals and preferences. If you're looking for steady income, potential tax benefits, and the chance to leverage your investment with a mortgage, real estate could be your path. If you prefer a more hands-off approach with lower initial capital requirements and the potential for high returns over time, the stock market might be a better fit. Remember, both options come with risks and rewards, and it's not always about choosing one or the other. Many investors choose to diversify their portfolios, balancing real estate and stocks to create a stable, growth-oriented investment strategy. Conclusion. So, whether you lean toward real estate or the stock market, it's crucial to know your financial goals, your risk tolerance, and your investment timeline. You don't have to go it alone. Consider speaking with a financial advisor who can guide you through these options and help you create a strategy that works for you. What about you? Are you team real estate or team stocks? Let us know in the comments below, and feel free to share your investment strategy. Thanks for watching Factful Finance. If you found this video helpful, don't forget to like, subscribe, and hit the bell to stay updated with all our latest content. Here's to making smarter financial choices.